Welcome to episode 23 of the Cashflow Connections podcast. The topic for today is taking a detailed look at multifamily underwriting. That's right, we're finally going to discuss how you should be underwriting your investment opportunities, and we have a guest who knows the multifamily business inside and out. In fact, their team has created one of the most sophisticated underwriting models that I have ever seen. You frequently hear people talk about institutional quality, this, that, and the other thing. Well, when it comes to underwriting, there simply isn't a level that's higher than the way that our guest understands this portion of the business. So in the discussion, we're going to talk about return on cost estimates and rental increase rates versus expense increase rates. We're also going to talk about economic vacancy versus physical vacancy and operating expense ratio compression. Now, I know this sounds like it might not be the most entertaining conversation, but if you're looking to learn something today, this podcast is going to help you tremendously. Now, before we get started, just a quick reminder, we only have a few more weeks left in the Cashflow Connections referral program. So if you know accredited investors, make sure to go to Cashflow Connections, sign in, and we have a tab now on the website that says Share CFC. So when you click that tab, you're going to see your own personalized referral link, and all you have to do is copy that link and post it to your social media accounts or copy and paste it into Gmail and send it out to your friends. And if anyone uses that link to sign up and completes a introductory call, we will send you a $200 Amazon gift card per referral. And like I mentioned, we already had an investor cash in 4 of these just last week for a total of $800. But don't forget, this program is only available until November 15th. So don't hesitate, go ahead and log into your account and click the Share CFC tab and share that link with your network. Probably the easiest way to make $200 right now. All right, let's get straight to the episode. How's it going, everyone? Our guest for today is Antionio Marquez, who is the managing partner of Comunidad Realty Partners. He is responsible for strategic planning, capital raising, and is the chairman of the firm's investment committee. He has experience overseeing and managing more than 2 million square feet of office, retail, and industrial space, and has been involved in multifamily real estate transactions with several high-level firms, most notably Carlyle, GE Capital, Prudential, and the list goes on. So, Antonio, thanks again for jumping on. I have been very excited about this conversation, so really appreciate it.
My pleasure, Hunter.
Awesome. So before we jump into the details about this one particular property, tell us a little bit about your background and how you got started in real estate in the first place.
Yeah, so I come from a family of immigrants, as a matter of fact. So my father came into the United States back in the 70s, and he was a consummate entrepreneur, very humble beginnings. He was a field worker in California, in Central Valley of California, and ultimately was able to scrape together enough money to start a company out of his garage. And he worked in a number of different segments of from food service to hospitality. Again, he started as a field worker, but he understood that space really well. And he also understood, his heritage and his background and his culture. And so what he started out of his garage was a distribution company. So what we would do is we would import and distribute Hispanic food products, specialty products. And this was back at a time where there was very little competition, burgeoning demand, and he just applied, best principles and just hard work ethic and all the things that typically kind of contribute to a successful company. And he would always say, I was an overnight success. It was just 30 years in the making. And so that was kind of his mindset. And he turned that into the largest distributorship of Hispanic food products west of the Mississippi. Then leveraged that into other verticals, all within his niche, all within his core competency of understanding of Hispanic consumers. They started an entertainment company. They started a telecom company, and ultimately real estate. And so I was cut from that cloth, growing up with my father and uncles and family, and it was a family business. And so we had an operation that was serving some of the largest multinationals in the country, because we started mom and pop, but then we grew into some of the larger retailers, Kroger, Target, Walmart's our largest account. And then he would leverage that into real estate, because as we were building that food distribution business, we became vertically integrated and started buying industrial facilities, throughout the United States in markets that we really liked long term. We were making, big bets and commitments into those markets. And so I grew up with that around me and that in my blood. And it wasn't, fancy Argus runs. It wasn't, institutional underwriting or anything to that effect. It was just good old fashioned, blocking and tackling and things that were just made sense. Right. And so fast forward 23 years, I was the first to graduate college in my family, on my father's side, and ultimately, really had an affinity for real estate and, really said, listen, I'm going to get into real estate. I've got to have some sort of, comparative advantage, right? I mean, going into the space and trying to compete with everybody else, and particularly in the four major food groups, there's a lot of commoditization that occurs, and so we really wanted to create a differentiated platform that was, serving the largest, the fastest growing kind of tenant in multifamily. And we like multifamily for all the reasons that most everybody else does. And good fundamentals, liquid with Fannie and Freddie, relatively liquid anyways, supply demand imbalance. And what we thought was fascinating about multifamily is if you look at the space and you look at the segmentation of the space, there's approximately 17 million units, of which 12 million units are what would be considered workforce housing, and that's defined as residents that are making anywhere from 60 to 100% of AMI, or 50 to 100% of AMI. That's how ULI defines it, anyways. So we felt that there was a big market. We felt it was very fragmented. It wasn't very institutional, and it's really most of the assets should be run as a business. And since we had this unique blend of business acumen and, growing large companies that serve some of the largest, companies in the world, along with the real estate, experience, I felt it was a very interesting proposition to fuse those two in conjunction with our kind of, tenant expertise or consumer expertise or demographic expertise. So we combined all those things. I started the company officially in 2007, but we had really kind of germinated this idea back in 2004. We opened our doors in 2007, and that's either the best or worst time to start a real estate investment firm. I'm really a half, a glass half full type of guy. And it was a great time to start a real estate investment firm. A lot of the groups that were, undercapitalized or didn't understand the business, or were just trying to do the next investment du jour, that were really in it for the long term and committed to, their strategies. They had kind of been, flushed away, and so that represented a great opportunity for a young, upcoming, ambitious kind of minority group that was trying to serve the needs of workforce housing throughout the United States. So that's how we started. That was our premise, and the investment thesis was pretty simple. We wanted to provide a differentiated experience and a product to a market that is highly commoditized, highly fragmented, and is operationally intense. And we felt that we had the skill set to be able to deliver on that. So that's a little bit on our background. And happy to share anything else on our background or how we got to where we're at today.
Perfect. So in terms of within the multifamily sector, what niche are you really focusing on in that sector?
Workforce housing. So that's BC assets that were built anywhere from 70s to 90s, and also defined as residents that are earning anywhere from 50 to 100% of area median income. And we're investing in markets that we feel exhibit some of the strongest population, household formation, income growth, and have, strong job density today, but also are forecasted to add, more jobs than maybe some other markets in other parts of the United States. So we're really kind of a Sun Belt focused firm, so Southwest and Southeast, and we just feel that those markets, from a secular standpoint, are going to grow well over the long term, and likely outperform some of the other markets in the United States.
Got it. And so just to kind of give the listeners an idea of what rental rates. So give us an idea in terms of rental rates, dollars per square foot or monthly rates, let's say net to the renter.
Sure. So our rental rates can be anywhere from $400 to $1,200. So that's your range. And then there's generally approximately $800. And so we're buying assets that average around 750 square feet. So that takes you, north of about $1.05 a foot in terms of rental rates, generally.
Got it. Okay. And so obviously, multifamily has had a significant run up since you started, right after you started the business, I should say. So what metrics are you currently looking at when you're trying to identify an opportunity in the multifamily sector?
We're trying to find, so our view is, jobs drive everything. And from, tax revenue to gentrification of certain neighborhoods. And if you have jobs and they're quality jobs and their, incomes are increasing, then that translates into healthy fundamentals from a multifamily standpoint. So we look at jobs first. Where do jobs exist? What is the composition of jobs? What's the diversity of jobs? Investing in Midland, Odessa, or South Dakota just because there's an oil or fracking boom is not interesting to me. It may have some great upside during a short period of time, but you're very exposed. So we're looking for markets like Dallas and Atlanta and Phoenix that are very diverse from a job base and growing from a job base. We look for infrastructure, schools, hospitals, investment into the local economy beyond just jobs as well as what is the local government doing to ensure that the growth of that particular MSA is sustained. You can look at a market like Austin that's had exponential growth, and city council, in my humble opinion, could have made some different decisions earlier on as the growth was occurring, and there was a little bit of NIMBYism that occurred, and they didn't invest in the infrastructure. The market, grew regardless, and it's still a good market, but it's just those types of decisions that can next to a market that we're trying to track and stay ahead of. The other thing that we're looking for is we want to ensure that there's liquidity in the market, and what I mean by that is there a lot of deal velocity, and so again, you can look at a market like Indianapolis, for instance, and good jobs, good diversity of jobs, good secondary market. I think there are definitely some good buys there. But we always look at our deals with the lens of what is the exit strategy. Are there a lot of trades? Are there a lot of buyers? Is there a lot of liquidity and relative liquidity again in those markets? And we try and buy in those markets because we can trade in and out of them. Now, the trade-off to that is that those markets can have lower cap rates. And we think that's a worthy trade-off to have a slightly lower cap rate, but the benefit of that is that we get exit liquidity. So a 25 basis points difference in liquidity in a market is well worth it. Because if you got a high cap rate market that you can't trade out of, what good is that? Especially in a downturn. So we think through those types of things, and there's a whole host of other items that we can get into, but it's primarily jobs, it's liquidity. We really look at concentrated markets, so really creating critical mass in certain markets. So it's really the Warren Buffett approach to real estate investing, where if you overly diversify, then you're just reverting to the mean. And if you're doing that, then why don't you just buy a REIT, right? Just buy an apartment REIT or buy something else. I think the reason that you would be investing with a group like ours is because we can drive alpha. We've got domain expertise, and we know our markets intimately well. So that's how we kind of look at our acquisition pipeline and criteria.
Makes total sense, and I appreciate the details there because it's definitely painting the picture of where the upper hand is, where the advantage is, and I agree completely with your reversion towards the mean statement there. That's something that People want to focus on diversification, but it's key to understand that when it comes to investing, you can invest exclusively in asset classes, markets, or structures where you have an advantage, you have an edge. And I think it's necessary to do that. And you can't have an edge over everything. So it's important to kind of think of that as you're building your own portfolio. So one of the reasons that I wanted to have you on today is to talk about underwriting. And the reason I wanted to have you specifically talk about this is that, in the deals that I've reviewed of yours, your underwriting model is just incredibly detail-oriented, incredibly sophisticated. And I know that you take underwriting very seriously. So I wanted to talk to you about a recent purchase you guys did in Atlanta. So give us kind of the high-level thesis of the portfolio and talk us why this interests you in the first place.
Yeah. So Atlanta, just so carrying on and segueing into the deal specifically, but talking really high level about Atlanta. Atlanta exhibits all the characteristics that I just laid out: job diversity, great infrastructure investment, great school system, all those different things. Plus, it has a very strong working class base that's growing. About approximately 70,000 jobs every single year in Atlanta, and of those 70,000, 65% are workforce. And not coincidentally, most of those jobs are being filled by Hispanic residents, which also fits our strategy. We're not, for us, at the end of the day, we're agnostic, but we do have experiential elements that we think that can be more inclusionary. So Atlanta had all those items, all those factors in the makeup. We also looked for assets in specific submarkets or subpockets. So like I was talking about earlier, my family has a distribution portfolio, so we can leverage that for kind of on the ground intel in terms of what are the emerging subpockets or submarkets of a particular market. So we've been pursuing projects in Atlanta for 2 years. We finally had a tiger by the tail earlier this year, where we had it was really an unsolicited offer that a group introduced us to an owner in Atlanta. He did not want to sell. It literally took us 5 months to convince him to sell. And we put it together, completely off-market deal. The thesis of that particular deal is the asset was acquired like a year and a half ago. So that's one of the reasons that the seller didn't want to sell, is that yes, the property had appreciated significantly since his buy a year and a half ago, but there's still a lot of meat on the bone, and I'm sure he knew it. But we represented an opportunity to take down a large portfolio of his and provide him, again, liquidity and an exit. But we saw that most of a lot of the heavy lifting had been done, but the cream at the top, it was still there. And so we put the deal under contract. It was 301 units. So I'm going to take one of the assets that we can use as an example in the portfolio. It was 301 units. We put it under contract for $23,175,000. It was built in 1979. The average square footage was 1,100 square feet. So it's a true Class B in a workforce market that was growing dramatically. And the amount of equity that was required on this particular asset was $8.6 million. In the portfolio as a whole, it was $15 million. But this asset, when we allocated it out, was that. And then our cost per door on the purchase price was $77,000 a door, which was $70 a foot, and our all-in cost was $89,081 a foot. To give you some context there.
Okay, perfect. Yeah, I appreciate the specificity there. And so, are you rehabbing all of the properties in this particular asset, or are some of them being rehabbed? What's the story there in terms of the value add?
Yeah, so our value add approach is we look at everything really from a we have to justify expenses, and so we're looking at everything from a return on cost standpoint. And so and there's two ways to do that. really. I mean, one, the unit upgrades that we do, and on this particular transaction, we're scheduled, our budget is $3 million, of which $1 million of that 3 million is going to go into interiors. And then the remainder is going to go into exteriors. So we were forecasting to do 250 unit upgrades. So on those 250 unit upgrades, we look at it just as a return on cost. So what is the rent premium that we can get on that renovated unit and per month, and take that across a year annualized, and then you want to divide that by your actual upgrade cost for that specific unit. And our target is 20%. That's our general target. So it's a 20% return on cost. And we also there's another metric that we look at as well, is not only what is your return on cost or your payback, right? Because that's, the return on cost and payback is inversely related, but also what is the capitalized value of that incremental revenue that you're adding. So, for us to do a unit upgrade, it doesn't cost more to operate that upgraded unit. If anything, it costs less because we're getting new appliances that are energy efficient. We're doing LED lighting. So we have this whole green bend to our platform as well that we're very proud of, that we can get into later. But yeah, it doesn't cost anymore. So in other words, that if we're doing an upgrade and we're trying to generate a $100 premium, that's a $100 premium immediately to the bottom line. So NOI, capitalized at a 6, that adds up. So in that particular case, we're looking at a $100 premium. It's $1,200 in any given year. Again, we view that as largely profit, right? There's not a lot of diluting effect from expenses, because as I said, if anything, it's probably less expensive. But at a 6 cap, it's $20,000 that we're ultimately adding. And then you take that against your cost, which typically it's $4,000, or maybe even $5,000. So it's like $15,000 a unit that is value add, right? It's accretive to the tune of $15,000. So we look at the return on cost is 20%, and then we look at the capitalized value, and we try and see if it's accretive relative to the actual costs and the spend. The amenities are a little bit different.
Before we jump into that, because that was just so much content and all of it's very useful. So if you're utilizing, let's say 250 doors basically, and you're rehabbing for about $1 million, so you're looking at somewhere between $4,000 and $5,000 per unit. That's what you mentioned, right?
That's right.
So you're adding about $100 per NOI on a per property basis. By implementing that. And that's kind of where you're looking at. So if you spend $4,000, you want to be able to increase the rent by $100, correct?
Approximately.
Okay,
Yeah.
got it. Somewhere between $4,000 and $5,000 per unit. And then, okay, great. And so that's a really good metric there that I think a lot of listeners will appreciate. And now let's talk about what you're kind of alluding to there, is the exterior, or amenities and exterior, et cetera. So, and I'm very interested to hear how you get perspective on this, because sometimes it's hard to quantify the rental increases from an exterior or amenity type of ad. So what are your thoughts on that?
Right. So, one, we need to get to par. And what I mean by that is we need to get the property to a level that is consistent with the market. And so, part of that is deferred maintenance. Another part of that is, if you have 80% of your competitors that have a playground, well, you need a playground just to get to par, right? I don't look at that as, it's an amenity, but it's not going to be an accretive amenity where you can start charging, higher rents or generate higher occupancy because you're differentiated. So what we have to do, in addition to surveying rents, we have to survey amenities in the market and see what our competitors offering. And we need to get to that baseline. And then beyond that baseline, we look at, the amenity set as accretive and value add. And so, we do a lot of different things that are unique to our platform from an amenity standpoint. Like we'll do self-storage, right? And maybe some of the listeners invest in self-storage. I love self-storage. If I wasn't doing multifamily, I'd be doing self-storage. And the beauty is I can do both. Yeah, no, it's a great space. And so since I couldn't do it directly because literally all my time is spent on this because I enjoy it so much. But we started doing storage at our properties. We had excess land that was just idle, right? It was not capturing its highest and best use. And so we said, let's put some storage on these sites, and why couldn't we be even more competitive than some of the self-storage facilities where it's kind of a convenience game in many respects. So we did that. I mean, it's not large scale storage, but we'll go in and put a row of 10 mini storages at a property, or 15, and we'll scale up accordingly based on demand. We have properties where the residents actually rented storage from us while they were leasing their unit. They move out, and they're still paying us for the storage. So they're still using our storage, although they're not tenants of the apartment itself. Mm-hmm. So that's how we look at those amenity sets where we can actually monetize, and those are easy to demonstrate how we monetize them. What's a little less, what's a little bit more gray is if you have again, like a barbecue area or a dog park and those other amenities. And we have a different kind of way of analyzing, that return, and we try not to get too complex, but it's effectively, what is the revenue gain, the total revenue gain, right? Because it's not just rent, it's also occupancy, and it's concessions and delinquency. So what is the total revenue gain? And whatever the difference is between the market rent, which will just happen, organically in the market, and whatever we've boosted. And you can even strip out some of the unit upgrades if you like. But so just looking at that differential. So in other words, if the market grew 3% and we grew revenue by 7%, then that 4% you strip out and you look at the revenue that you added, and you divide it by what your costs were, your CapEx costs that were truly value add amenities. So that's how we look at that.
Got it. Okay. And in terms of the interior, just to jump back to that real quick, how long are you taking to complete those rehabs?
So the way that we handle those is we handle them as the leases roll over. So you'll typically have, we typically have 50 to 60% turnover, maybe 40%. So it normally takes 2 years for that lease to roll over entirely. And so we're waiting just for those leases to roll over. In addition to that, we want to keep tenants. So, we have kind of an ethical dilemma, frankly, because we're not trying to displace tenants. We're just trying to, take the asset to the highest and best use. And so we work really, really hard to keep people in place that can afford, the property when it's ultimately upgraded to be, consistent with the market. So what we do for those residents that are renewing is we'll do kind of a partial upgrade. We'll just do what we call a mod. It's called a modified upgrade. So you may not get flooring throughout. You may not get all the, the fancy bells and whistles, but you can get a new appliance package. You can get flooring in certain areas that we can control. We can even do some light fixtures. And that's so that the resident is actually getting something for the renewal rent increase, and we don't have as much turnover. And that also helps us, add the upgrade unit count. It extends the useful life of the property and allows us to kind of accelerate the unit upgrade program so that we're not waiting a full 2 years for all the leases to roll over.
Right. Makes sense there. In terms of the occupancy, you may have mentioned it earlier in the introduction, but what's the current occupancy of this Hickory Grove property?
98%.
Okay, got it. So that's why it's so critical to properly underwrite the time at which it takes to do those rehabs. Now, it's different, of course, if you're taking a property from 65% occupied to 98%. But if the property is fully occupied, you have to be very cautious to ensure that the rental increases are only going to be taking place as those rehabs are being completed, because the reason the rental increases are taking place is because of the rehab. So you have to make sure that, your assumptions there are conservative on both ends, not only in terms of when people are going to roll over, but in terms of actually the time it takes to actually complete those rehabs in order to implement the rental increases. Is that what the market occupancy is, or is that above market?
No, that's above market. And we'll have people that say, well, is 98% occupied. What value add exists?
Exactly.
That's exactly that's exactly what we look for, is assets that are overoccupied. I mean, so there's two ways of looking at value. I mean, one, yes, and it's very obvious and tangible. If you have lower than market occupancy, you can, move the needle. But the markets that we're investing in, it's not like you're buying assets that are 65% occupied that should be 90%. You get that a lot in retail and office, where you have large users and you can have that, that sort of delta. Really, if you have an asset that's under 85%, there's a real issue at that property, and those are few and far between. The reason we like these markets is because there's a lot of demand. There's a deep pool of tenants. And so the real value add is making sure that the rents are optimized, and economic vacancy is as tight as it, can be. So it's not just physical occupancy, right? I could have a project that's 99% occupied, but the economic occupancy is 80%. And economic occupancy is really is net of physical vacancy, concessions, delinquency, and loss to lease. I don't know, I can go into any of those, but suffice it to say that physical vacancy is not the only thing that matters. There's a lot of other categories in terms of net rental revenue, not just occupancy, that actually matter. And so again, when we go into these assets, we look at every single one of those categories and figure out how we can tighten them up. How can we be as efficient as possible? Occupancy, again, at 99% physical, to me, signals that rents are under market. You just have not pushed rents fast enough to meet the market. Our optimal physical occupancy is 95%, and our optimal economic occupancy is approximately 90%.
Got it. And in reviewing the underwriting, I actually saw that you noticed that you started at about 291 occupied units, and at the end of the 12-month period after purchasing the property, it's down to 283, which is interesting because, based on the conversation, it sounds like that's close to where the market is, especially when you think about the rental increases which will be taking place in there. It sounds to me like the property is under market rent regardless of the rehabilitation of certain units. Is that correct?
Correct.
Yeah, this is why the occupancy is so high.
Yeah, and as of close, the occupied units was 295.
Okay. So wow. So
they even.
Well, that's great, right? Because the reality is the physical occupancy, the stratification there, or the delta there between the physical occupancy and the economic occupancy is really important. And you mentioned self-storage. This is something I talk a lot about in self-storage because of the complexities of the asset class, the differential can be really, really significant, because not only do you have things like concessions and loss to lease, et cetera, you also have a tremendous amount of ancillary income items, now some of which you're using at your properties, just the self-storage, for example, which is obviously one of those ancillary income items.
Yep.
So you mentioned lease renewals. What are your underwriting assumptions for renewals, given those increases in prices are taking place? Does that change the formula there?
Yes. So that's dynamic. So we have a pricing algorithm that we use, and we even go as far as doing renewal probability analysis, where we'll do length of stay and a bunch of other metrics that go into it. There's some constituent parts so that we can figure out how likely a tenant will renew. And this is something that we believe in a big way, is just data analytics, big data, machine learning, predictive analytics. So we're actually incorporating that. It's still in its nascent stages, but yeah. So renewals, we take the approach to just kind of high level is what is the discount to market. So we know what we're getting on the market on the street today. So what sort of discount is appropriate for loyal residents? And that's how we look at that. And how we have basically an analysis that says, and this is all a function of where we're at from an occupancy standpoint. What is the uptake on leases? right? So we're always looking at renewals in terms of how strong or desperate we are to keep that renewal. So if we feel pretty good about our leasing on the front, in the front door, and we're getting the $100 pops and we're maintaining 95, 96% occupancy, then our discount to market will be lower, right?
Right.
Because that means that the renewal rent that's coming up, their discount is going to be lower than maybe if our occupancy was in the 90s and we were going into the slow winter months and we weren't leasing as frequently, then we're going to have a higher discount to market for those renewals. So that's how we handle that. But yeah, there's a lot that goes into it, but that's kind of generally that's a high level principle is the discount to market, and that's all a function of where the asset is in its current state from an occupancy and leasing standpoint.
Okay, got it. And in terms of early move-outs or evictions, what percentages are you assuming will go that route?
Great question. So that one's really hard to really figure out. It's even tricky to figure out during due diligence. But generally, we think that we should be under 5%, and even that's high. I mean, we're really trying to get it to 2% of early move-outs from eviction skips. Early terminations, we're not too concerned about, but if we have a lot of evictions and skips, then there's two issues there. I mean, if it's an eviction, then that means that maybe we didn't properly screen, so we need to go back to our screening protocols and figure out if we loosen them up, if we were more accepting, and if we need to get more stringent on our screening criteria. Also our collection practices too, not just what our screening was in terms of the lease, but what are our collection practices like? Have we been filing early? Have we been sending out notices on the 3rd or 4th of the month? We're now going to electronic payments completely. So a lot of our properties, and we're trying to get full penetration across the board in our portfolio, where we only accept electronic payments. We don't accept checks. We certainly don't accept cash. So that's another component. Does that property have full penetration on electronic payments? And then, secondly, on the skips. So the skips, for me, if we do have a high incidence of it, it's more of a reflection of our customer service, more than anything else. If we're doing everything else right, then people may be skipping just because we aren't handling service requests. There is also a cultural component to skips, and the reality is that we do have tenants that actually move out on a seasonal basis, and they may not understand their full lease obligation, and that's okay. So what we need to do in that instance is we need to look at our education and how are we communicating, and are we communicating the lease obligation in Spanish? We also have created basically a vacation program where there's relief over a period of months that we effectively just defer a portion of your rent so that you can pay it when you're back and working again. So we do that on high quality tenants that really have not missed payments in the past, and that's really to kind of hedge against any skip risk, particularly during the winter months and other seasons where we may have larger than normal skips.
Got it. Okay, cool. I appreciate that there. Just to kind of give the listeners a frame of reference here. So in looking at the underwriting assumptions, I see there's about a 7.6% rental increase in year one and then a 13.8% rental increase in year two, which is basically taking the rental rates from $843 to 1,033. That's kind of the transition the property's going into. And then from thereafter, it looks like the rental increases are about 3% a year during the duration of the hold. Now, this is really critical if you're reviewing deals and you see there's two things to think about. Number one, you want to make sure that those rental increases up front are substantiated by market demand, which means you're going to pull comps and stuff. That's obviously something we can't do over a podcast, but that's important. But then also from an underwriting perspective, you want to make sure that after those value add policies are implemented and those rental increases are effectuated, that the per year increases does not continue on as if they're continuing to add significant value to the property. So basically what the underwriting assumptions are showing is that now that value has been added, now that we've brought the property up to market rates, we're going to stabilize these increases at 3% a year. And just out of curiosity, what is and I didn't take a second to look at this, but what is the expense ratio, the expenses, what are they increasing by after year 3, let's say?
So our expense escalation are 3%.
Okay.
So we just match up to the rent growth.
Right. And that's really important. And you'll find, especially if you're looking at a deal that is a 7, 8, 9, 10-year hold, if after that value add proposition has been effectuated, after rents have been increased and the market is stabilized with those 3% rental increases thereafter, you want to make sure that the rental increases and the expense increases are in lockstep or very, very close. Because if there's a difference, even if it's 4% rental increases, 3% expense increases, the difference is literally exponential. And so the more years you do that, they're compounding further and further, and you can have a significant perceived increase in your cash on cash returns in year 7, 8, 9, 10 because of that exponential differential between 3% and 4%. Sorry about the tangent. That's just something that's really important. And the fact that you guys underwrite it to lockstep is really critical to kind of highlight there. So just to kind of give a perspective, what is the going in cap rate of the property?
On this asset, it was a 6.33.
Okay, and
is going in place cap rate?
Okay, is that based on the trailing 3, or the trailing 12, or is that based on normalized expenses?
So our underwriting is trailing 3 NRR, net rental revenue.
Okay.
Trailing 12 other income, which is like laundry fees, application fees, utility reimbursements. So trailing 12 there, and then it's T12 expenses that we normalize. And then we adjust property taxes up. And we also include a replacement reserve of $300 a unit into that expense assumption. Got
it. Again, this is why I'm excited to have this call. Listeners out there, that is the right answer to that question. The amount of detail there and the knowledge there is critical. If you're looking at investing a deal, they should be able to have that answer ready for you. And there's a lot of different ways to manipulate cap rates, so appreciate that. Just out of curiosity, then, how long does it take to get to the stabilized cap rate? I guess 2 years, because you're burning off the concessions and raising rents. Would that be how you consider that, just based on the rental
Correct.
Increases? Okay.
Exactly. Yeah, approximately 2 years.
Do you have an idea of what the trailing 12 operating expense ratio is?
Yeah. So the trailing 12 ratio is 53%. We feel that there are areas where we can actually save on expenses. I can go into detail as to where we think that we can do that, because it's not just revenue, right? I mean, value is created through NOI expansion, not just rent increases.
Right.
So expenses are just as important. And for us, we love expense upside. Because that's tangible, it's there, it's something that we can, control much more effectively than, hoping that we get a rent when we have unit upgrades going out to market. But yeah, so in year 1, it's 47% is our OpEx margin, and year 2, it's 43%. So part of that is just because there are some revenue increases, so that's why you're seeing the differential. We think that the expenses will be a little bit higher in year 1 versus year 2 as we kind of taper off and normalize in the stabilized, asset.
Got it. Okay, cool. So basically you're going from, I think you said 53% operating expense ratio based on trailing 12 to a 47%. Is that correct?
In year 1,
to 47?
Yep. And then, and then 53 to 47, and 43% in year 2.
Okay, perfect. Also, one of the things I saw reviewing is that the trailing 12 repairs and maintenance is significantly different in the trailing 12 and the year 1. Can you explain kind of the differential? It looks like the previous owners are spending 2 times what you guys are anticipating spending. How does that happen?
So there's a couple of things. One, so this asset was acquired a year and a half ago. And so the seller did actually put a decent chunk of change into the property. And this gets into accounting standards and GAAP accounting versus non-GAAP, and how you conform your financial statements. And so once we look through the general ledger, so this is another due diligence note. As you get financials, don't take it at face value. You want the backup, and you want the general ledger detail information. And that general ledger detail, if it's done correctly, it's going to show you every single expense. It's going to show you a description. It's going to show you invoices. It's going to show you dates. So we scrub all that. So we go through the entire general ledger detail. And when we look through the general ledger detail, we saw a lot of expenses that should have been capitalized that came out of his CapEx budget. And so what we suspect, and arguably it's a smart tax strategy. It may not conform to GAAP. You may be questioned if you have an audit. But what he was doing was he was booking a lot of things that should have gone below the line, below the NOI line as capital, and he was doing it above the line as R&M. So that's not the proper accounting. And so that's the differential. Our number is reflective. So just so that you have some context as to how we got to our number. Our number is using expense benchmarks in our portfolio. And that's also another advantage. If you have a large portfolio, you can pick, through other assets that are similar in vintage, size, all those other things. And that gives you really good detail and ultimately confidence as to how you're going to execute. If you're, running the 3,000 units in a 7,000 unit portfolio and they, match the asset that you're acquiring, you have a pretty good, degree of confidence that you can, operate this new acquisition at a similar level.
Got it. What financing are you attaching to the portfolio or the property in particular?
This financing was Fannie Mae financing, and it was a floating rate, 10-year loan with 4 years of interest only, and it was 215 basis points over the 30-day LIBOR. So our all-in rate is like 3.4, interest only, 10 years. And the other beauty of this product, and it's not available to everybody. That's the other thing. It's kind of an esoteric loan product that not a lot of people know about, but there are some qualifications. The loan has to be over $20 million in debt. So that's why it's not available out there to everybody, but it was available to us. Again, that interest rate is extremely low. The other feature that I like about it is we can convert over to fixed after year one. So to us, it's like the holy grail. I mean, we can have a variable low interest rate, below a fixed rate that's floating with interest, only for 4 years. Plus, if we see that the market takes a run and interest rates, rise, we can convert over to fixed within 30 days. So we really like that feature.
Oh, within 30 days at any time?
After year one, yep.
Wow. Okay.
Or after month
that's
13,
interesting.
I guess.
Cool. And give us an idea of the size of the loan then, and comparatively to the purchase price or the value.
Mm-hmm. Yeah. So the loan was 72% of cost. Is what it was. It was $19.34 million and was 72% of our total project cost. And project cost is your purchase price, the CapEx, plus any of your closing costs.
Okay, got it. So the purchase price is $23 million. I think you said you're putting another $3 million into it. So that alone gets you pretty close to that number right there, just regardless of the closing costs. So that makes sense. The initial debt service coverage ratio on the purchase?
Our DCR was 140. So the deal covered very well. We didn't have a sizing issue with the DCR. We were just capped by the value of sales comps, not by the DCR underwriting.
Okay, that makes sense. Reserves. Talk to us about the reserves you're keeping and how you establish and underwrite what is appropriate to take on a property with this profile.
That's a tricky question. But it's a very important one. And I think many people are getting very aggressive with reserves. I think the mistake that a lot of people are making is they're doubling down on rent growth and they're reducing their reserves, and you should be doing the entire opposite. And that also means that the return expectations should go lower too, in my opinion. I still think we're going to see some great returns, but I don't think you should be swinging for the fences at this stage of the cycle. I think risk adjusted, there's still some great opportunities and good locations at cash flow. But yeah, reserves is one of those things that, one, you have to have a good construction team, you have to have good contractors, and that properly assess what the condition of the property is. And they'll provide replacement reserve cost tables that you should really be intimately involved in, or at least have somebody that you trust that has deep construction management expertise in multifamily. And there's firms out there that do that on a contract basis. There's not a lot of them, but they're out there. And once you know that, then you can properly reserve. But it's almost like buying a car and not getting a Carfax, right? And you just assessing whatever you think is going to be necessary to maintain that car. And I'm talking about beyond an oil change.
Right.
So you don't do that with an asset that's multiple of millions of dollars. You just don't do it without a Carfax or without some sort of expert that actually can tell you what is the condition, what is the history. You can look into that and then give you real kind of bid out costs of what it's going to take to maintain this thing. And so you can do that as a blend of upfront, right? You just take care of a lot of it now if you have the capital, or you can do it over a period of time, but you need to ensure that you properly reserve, because what's going to happen is, if a market turns on you and rents go down and you're squeezed, your OpEx margin really is
expands.
Expands. Then you need to make sure that you have enough reserves to cover for a shortfall in a tough time. So that's how we kind of view that piece.
Yeah, makes absolute sense. It's obviously property dependent, but more importantly, you have to have experts give you a thorough analysis of the current state of the property before estimating those reserves. And you'll find that some people may have just a standard underwriting in terms of reserves per square foot or reserves per cash flow or something like that. And it needs to be looked at on a property basis. Just looking at the underwriting, I see that the purchase cap is close to a 6.12 and the exit cap is close to 6.5 or so. Is that typical in the deals that you do during your hold periods to, let's say, is that a 4-year period then? So it looks like 0.1 bip per year or something like that. Is that how you're doing that? Or what's the thought process behind that cap rate expansion during the hold period?
And you're talking specifically about the exit cap that we have in our
correct.
Control tab, right? 6.5,
yes.
Yeah. So yeah, as of close, so the NOI actually grew since maybe that last model that I shared with you, Hunter. So we were at 633, and the 6.5 cap was on exit. So the way that we look at exit cap is, and this follows most institutionals' thinking of exit cap rates, but you want to know what the prevailing cap rate is in any given market, or the spot pricing is what they also call it. So in a market like Atlanta, you can call it a 6. It's probably closer to 5.5 right now, but call it a 6. And what you want to do is you want to add 10 basis points for every year of the hold. So if you're holding 3 years, it's 30 basis points. If you're holding 5 years, it's 50 basis points. So, our assumption here is the market is 6. We're probably going to hold it for 5 years, could be less, but we just plugged in an exit cap that was 6.5% because we anticipated holding this for five years.
Makes total sense. And we've heard that a couple times, and I misspoke. I said 0.1. It was 10 bips that I meant, but yeah, that makes sense. So you're saying the market right now is 6, you're selling in 5 years, so you sell at 6.5, and that's definitely reasonably conservative in the institutional industry standard at this point. What are some of the important metrics you look at when conducting sensitivity analysis in terms of identifying where the pressure points are? What are some of the ones you look at?
Well, exit cap is definitely one of them. It's
Sure.
one of the more important ones. And, if in our model that you have, Hunter, so we just have a sensitivity analysis that we can, toggle, dial up or down cap rates, and then we can see the returns over different hold periods. So we can run a sensitivity analysis at different cap rates. The other thing is just debt service, coverage. We have a stress test for debt coverage as well. We have a break-even analysis. And then, there's rent growth assumptions, the OpEx, margin assumptions. So all those things we run sensitivity analysis on, in addition to reserves. So that's kind of gives you a flavor for everything.
Yeah, exactly. Everything we cover today should be pushed and pulled to find out where the market, where the property has the potential to go sideways. And will give you a good idea of the amount of padding you have and to where you need to be conservative in your underwriting to make sure that you don't get into those situations. So just to wrap up, and first of all, thanks again for coming on. This has been really educational and very detail oriented. So I appreciate you kind of being so transparent. When it comes to real estate or just real estate in general, real estate underwriting, what are some of the big pictures suggestions you have for the new real estate entrepreneurs, professionals out there that are getting into the space?
Well, I'll speak to how I started, and I started. Nobody taught me this business, right? And so anybody on this call can do it. The reality is that it's a lot of work, and most people don't have the stamina. They don't have the grit. That's just a reality. So, my best advice is just if this is what you believe in, if this is what you want to create, if this is what you want to, build wealth for your family over the long term. One, it's just not easy. I mean, it's glamorous to talk about on a call like this and going through it, but it's the things that you do when you're not on the call, right? And nights and weekends and building it. And so my biggest advice is make the time commitment because it's not something that you can do. I mean, you can learn but when you get to a point, really, make the time to commit to it is probably the best advice that I can give anybody on this call. And how I did it is, so I had the work ethic. I put in the time, but I was also very humble about going about it. So I triangulated. I got on calls like this. I did podcasts. I talked to other professionals. I reached out to people, and I just put the pieces together. Don't feel like you're going to have the answer right out of the gate, but just go through a lot of different at bats. Right, just get the exercise in, get yourself in a position, work for free. Be an intern, go to, groups and just say you want to soak it up and be involved in that whole environment. And the rest will come. Don't try and figure it out yourself. Use, the power of the crowd or the network and, people that you trust or have, been successful, and just get fragments and then, put it all together and synthesize it. You're not going to get, everything from one particular source, but again, triangulate through a lot of different sources. And that's the best advice that I can give anybody.
Awesome. Well, I completely agree with that. And again, Antonio, thank you so much for coming on. Can't thank you enough.
Yeah, no, my pleasure, Hunter. Thank you for having me.
All right. Well, I'm sure you learned a lot in this episode. I'm really happy with the level of detail we were able to get into. I mean, obviously the guy just knows the business inside and out. Tons of sophisticated content in there, which is what I'm really happy about delivering. So if you want to get in touch with Antonio, feel free to contact him through his contact information provided in the show notes page. Also, don't forget, you only have until November 15th to send out those referral links. So log into your account with CFC, go to the Share CFC tab, and shoot that link out to your network so you can get some of that Amazon money. All right, everyone. Thanks again.